Welcome back to Investing Talk Podcast.
Today we're looking at Newegg Commerce. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The reason everyone is suddenly talking about this stock is a powerful combination of recent operational momentum and some pretty aggressive new financial guidance for 2025.
Yeah, and the whole investment case right now seems to center on one thing, doesn't it? Is this financial turnaround, real and sustainable?
Exactly. Or are we just seeing a momentum trade based on hopes and projections? That's the core question.
And when we talk about momentum, wow. We are talking about numbers that almost defy gravity.
Right.
The stock had that single-day rally, over 40%, just boom, right after they released that fresh 2025 guidance.
It was huge. And the year-to-date picture is even wilder.
Oh, absolutely. If you zoom out, the return is just staggering, sitting well over 600%. Now, that kind of explosive rise, driven mostly by forward-looking guidance, well, it usually raises massive red flags for me about market froth,
It does.
How do we separate the real potential growth from just speculative mania here?
Well, what's fascinating is that the numbers themselves, if they achieve them, they sort of explain the enthusiasm, even if the rapid climb feels speculative.
Okay, so break down those numbers for us. What's in that guidance?
So the updated outlook for the full year 2025 projects net sales between $1.38 billion and $1.42 billion.
Oh, okay.
Now, to put that in context, that's a projected increase of nearly $150 million compared to the $1.24 billion they reported in 2024. That is, that's serious top-line growth ambition.
It is, but the real story isn't just about revenue, right? It's got to be about execution on costs.
That's exactly it. This is where that operational momentum you mentioned really comes into focus.
Yeah, because just growing sales while losses balloon doesn't fix anything.
Precisely. And the narrowing of the net loss is the key narrative here. While, yes, a net loss persists in the projections,
They're losing money, yeah.
It's expected to narrow substantially. We're talking between $10 million and $16 million.
Okay, hold on. So compare that to 2024 again.
That's a massive projected improvement from the $43.33 million net loss they absorbed in 2024.
$43 million down to a projected max of $16 million loss. That's undeniably great movement, but
still a loss.
Yeah, it still means they are losing money next year, potentially, $10 million maybe? Why should investors price in a 600% gain just on the promise of a loss narrowing? What did they actually do operationally to achieve this huge projected cost correction?
That question goes right to the heart of the turnaround story, and our sources indicate this isn't just, simple cost cutting.
Okay.
It seems to reflect a successful restructuring aimed at efficiency. The two big factors appear to be inventory management and the successful execution of their third-party marketplace strategy.
Ah, the marketplace model. Less inventory risk.
Exactly. They're relying less on holding large inventories themselves, which is costly and super risky in volatile hardware markets.
Yeah.
And increasing the percentage of sales driven by their marketplace.
Which carries much higher margins, right? And less capital tied up.
Precisely. Much higher margins, less capital expenditure. And this operational shift, this is what fuels the bullish sentiment. Because investors are now anticipating potential upward revisions from analysts. If Newegg can prove this efficiency isn't just a one-off event.
Okay, so we have a story here of potential margin improvement alongside ambitious revenue growth. Let's pivot then to their current financial resilience. If they're in this high-growth turnaround phase, the last thing they need is financial stress.
Right.
What does the balance sheet tell us? Can they absorb any bumps in the road, any execution missteps?
Well, the balance sheet is actually a major positive factor here. It really supports a low leverage strategy.
How so?
The company reports no verifiable long-term debt in its latest disclosures. Zero.
Wow, zero long-term debt. For an e-commerce platform, that's unusual.
It's incredibly strong, especially for a platform that needs flexibility to scale rapidly and manage those inventory fluctuations we talked about. It essentially gives them a clean slate.
Okay, and they also raised a fair chunk of cash recently, too, right? Which I remember temporarily concerned the market a bit.
That's right. Let's talk about that $65 million at the market, or ATM equity offering.
Yeah, maybe just quickly explain for listeners what an ATM offering is and why it might cause concern even though it's bringing cash in.
Sure. So an ATM offering basically allows a company to issue new shares directly into the open market over time instead of doing it all in one big lump sum.
More flexible for them.
Exactly. It's a smart, efficient way to raise capital, and in this case, it definitely enhanced their liquidity by $65 million.
Yeah.
But it inherently causes fear of share dilution.
Because more shares mean each existing share represents a smaller piece of the pie.
Precisely. Every new share issued slightly reduces the ownership stake of existing shareholders. So the market initially reacted negatively, worrying that this cash raise might signal some kind of internal weakness rather than being for strategic growth.
Got it. So they have the cash now, they have low leverage, but they still need that business model to fend off giants like Amazon or other specialized competitors. What's their real competitive edge, their moat in this brutal world of PC hardware e-commerce?
The moat, I think, lies entirely in their niche focus and their brand loyalty. Newegg isn't trying to be everything to everyone.
Right, they're not trying to be Amazon.
No, it's a leading pure-play online retailer. They specialize specifically in high-value PC hardware, components, gaming electronics, peripherals. That term pure play, it means they live or die by the enthusiast market.
And that specific targeting is probably key, isn't it? Because that PC building and high-end gaming community, they're notoriously demanding.
Extremely demanding and very brand loyal. They tend to trust Newegg's reputation for having specialized inventory, maybe early access to new components, and supposedly more knowledgeable customer service. Things general retailers often just can't match.
Yeah, that makes sense.
And they're actively working to deepen that engagement too, which is crucial for cementing that loyalty.
How are they doing that?
Well, a fantastic example is the recent launch of their flagship 2,300 square foot gamer zone retail experience right at their headquarters.
Oh, interesting. A physical store.
It's more than just a store, really. It's designed as a physical touch point, something that cements the brand's presence in that enthusiast world. It helps turn digital loyalty into something, well, tangible.
Deepening the relationship with that core high-value gaming demographic.
Exactly. The very people who drive demand for the specialized, often high-margin components they sell.
Okay, that strategy, blending the online distribution muscle with that targeted, community-focused physical engagement, that does sound like a smart defensive move. But, fundamentals aside, money often flows where the charts point.
True.
So let's look at the technical momentum. What's the price action telling us? Is institutional money truly buying this turnaround story?
Well, the price action certainly seems to confirm a decisive bullish reversal, at least for now. The stock has rallied sharply. Was it 45% just since late October?
That's a big move in a short time.
It is. And crucially, in that move, it broke decisively above both its 50-day and its 200-day moving averages.
Ah, the golden cross territory.
Pretty much. That technical crossing is often seen as a major confirmation signal for money managers that the longer-term trend might have shifted from negative to positive.
Okay, so that breakout signals confidence. But let's look at the short-term reality for anyone trying to actually trade this momentum. The volatility has been just extreme.
Absolutely extreme.
What does the near-term technical outlook suggest for like a potential trading range?
Well, based on the current volatility in the chart data, the near-term trading range is suggested to be pretty broad, maybe spanning somewhere between, say, $58 and $100.
That's a wide range.
It is. And momentum indicators, specifically the MCD, which tracks the acceleration or deceleration of the stock's movement, they do confirm that the momentum is accelerating and is firmly bullish right now. However, you're right about the speed. That rapid rise definitely carries a short-term risk of the stock being technically overbought.
Yeah.
It could be due for a pullback, which is pretty typical for a stock moving this fast on anticipation.
And speaking of anticipation, let's quickly circle back to that ATM offering and the insider activity that followed. You mentioned dilution fears, but they seem to get quelled pretty fast by some massive internal confidence signal.
That's right. The signal was loud and clear. Those initial dilution fears were heavily offset by substantial insider buying.
How substantial?
Specifically, nearly $18 million in purchases by a major shareholder named Gulkin.
$18 million. Wow.
Yeah. When a large known investor steps up and buys massive amounts of stock immediately after a capital raise that could cause dilution, well, the market sees that as a huge, deliberate vote of confidence.
Okay, but let's introduce just a little skepticism here. Was that Gulkin purchase part of like a prearranged buying schedule? Or was it genuinely a spontaneous vote of confidence reacting to the company's future direction after that guidance release?
That's a fair question. While the market certainly interpreted it as a spontaneous signal, what probably matters most is the combined effect.
Yeah, the perception.
Whether prearranged or not, the purchase was executed publicly, strategically right after the guidance. You combine that $18 million show of internal conviction with the very high retail enthusiasm and the social media momentum surrounding the stock.
Right, the meme stock factor.
Well, maybe not full meme stock, but that specific combination is definitely the recipe for continued volatility and potentially sharp directional moves. Plus, the relatively small size of the public float makes it extremely susceptible to this kind of coordinated momentum.
Okay, that makes sense. Let's transition now, though, to the risk factors. We've painted a pretty optimistic picture in some ways, but we absolutely have to look at the why not buy now case. If the potential reward is a 600% run-up, the risks must be equally daunting.
They definitely are. And the first, most immediate risk factor for any potential investor has got to be the extreme volatility we keep mentioning.
Right.
We have to address the beta. It's 4.2.
4.2. Explain what that means in simple terms.
Okay, so beta measures a stock's volatility compared to the overall market. A beta of 1 means it moves with the market. A beta over 1 means it's more volatile. A beta of 4.2, well, that isn't just a number. It's basically a warning label.
So a highly amplified move.
Highly amplified.
Correct.
For an informed investor, a beta of 4.2 means, theoretically, if the broad market moves up 1%, this stock might move up 4.2%.
Yeah.
But critically,
Coincide.
if the market corrects just 1%, the stock is expected to crash by 4.2%. It cuts both ways, sharply.
And that amplified volatility directly reflects that execution risk you mentioned earlier, doesn't it?
Absolutely.
If they miss the top line or the bottom line guidance even slightly in these next couple of reports, the correction could be violent.
Painfully violent.
Yeah.
And that execution risk connects directly back to profitability. Remember, while the losses are projected to narrow significantly for 2025,
They still persist.
net losses do persist, and a return to sustainable, guaranteed, positive profit is not yet a certainty. We're still betting heavily on a successful turnaround that, frankly, has yet to be fully realized and proven out over time.
And beyond the company's own internal risks, the whole sector itself presents a huge external headwind, doesn't it?
Oh, absolutely. The e-commerce and PC hardware sector is inherently highly cyclical and extremely competitive.
Yeah.
This business relies heavily on discretionary spending, particularly from those enthusiasts updating their gaming rigs or workstations.
Which makes them highly vulnerable to, well, any broader macro slowdowns, right? Interest rate hikes, consumer confidence dropping.
Exactly. Or even just a general reduction in consumer enthusiasm for high-end gaming components, if the next generation of hardware disappoints, for example. Any kind of economic interruption could pretty easily derail their current growth trajectory.
Okay. So given the immense potential upside, but also the extreme volatility and those lingering profitability questions, the focus really has to be squarely on upcoming events, right? Events that can confirm whether this trend actually has legs.
That's right.
What are the major concrete catalysts listeners should be anchored to over, say, the next 3 months or so?
Okay, the near-term investment horizon is really anchored by two critical financial checkpoints. First, we have the Q2 earnings release coming up on August 29th.
Okay, Q2, end of August.
And then the really crucial Q3 release on November 12th. The company's ability to successfully narrow those losses, meet, or hopefully beat that ambitious guidance, that's what will drive major price action.
And a miss could trigger.
A miss could trigger a really harsh sell-off, given the valuation run-up. But a beat, especially on the loss reduction, will likely fuel the next leg of the rally, maybe towards that $100 range we talked about.
And since they are so deeply embedded in that gaming segment, those holiday season sales reports must be huge indicators too, right? Even before the official Q3 numbers.
Invaluable indicators.
Yeah.
We should start seeing initial holiday and crucial gaming sales reports rolling out probably in early November.
Okay.
This will give us a real-time pulse on their operational momentum right as they enter the peak retail season. It allows investors to kind of judge demand before the full financial data is out. A strong early performance could potentially overshadow some of those lingering profitability concerns, at least temporarily.
Okay, so earnings dates, holiday sales. What about beyond the confirmed dates? Is there any highly speculative upside that could maybe trigger a sharp rally towards the high end of that trading range, say $100 or even higher?
Well, there is certainly ongoing speculative chatter out there. The kind of stuff that, if confirmed, could immediately trigger sharp rallies, maybe towards that $100 to $130 range.
What kind of chatter are we talking about?
Whispers about potential gaming-focused partnerships, perhaps with a major chip manufacturer like NVIDIA or AMD, or maybe even a console developer, or perhaps an official confirmations of deeper international expansion efforts, maybe building on that successful gamer zone concept.
But these are just rumors for now.
Right. Currently just rumors, whispers. But the market seems primed to react instantly, and maybe excessively, to any confirmation.
Okay, let's quickly touch on the longer-term picture. Looking beyond just the next 3 months, the continued growth in the whole PC building and high-end gaming peripheral market, that seems like a secular tailwind for Newegg, right?
It definitely is. That market continues to grow structurally. And if the company really proves it can execute this turnaround consistently.
Yeah.
Their structural position as a leader in the enthusiast market, combined with that strong balance sheet we discussed, the zero long-term debt, the high cash position, it makes Newegg an incredibly attractive platform longer term.
How so?
Well, they are a focused vertical leader. And those kinds of companies always become potential M&A targets down the line, which adds a layer of long-term structural value for investors.
Interesting point. So, wrapping this all up, what does this mean for you, the listener, if you're considering an investment right now? We've seen rapid revenue ambition, confirmed bullish technical momentum, major insider conviction, but that's offset by extreme volatility and significant execution risk.
Yeah, weighing it all up. Based on the synthesized data we've looked at, we'd assign an overall bullish rating, maybe, say, an 8 out of 10.
An 8. That's quite bullish given the risks.
It is, but it reflects the potential upside. It appears highly attractive for both short-term trading, if you can stomach that extreme volatility and effectively leverage the upcoming catalysts, and potentially for longer-term investment, if you really believe in the sustainability of their brand expansion and these financial cleanup efforts.
So different strokes for different folks, potentially.
Potentially. But ultimately, the next two earnings releases, Q2 and Q3, they will be the definitive proof points. They'll show whether this strong 2025 guidance reflects a truly sustainable turnaround driven by real operational efficiency, or if it was just a temporary momentum spike.
That execution piece is everything.
Then execution is absolutely what you should be watching. Because if they deliver on it, well, this stock could still have plenty of room to run.